Chinese market specifically has actually seen very robust performance. I mean, we've had a little bit of a backup in yields recently. That sat alongside some improvement in the equity market, so maybe some domestic rotation of risk. But we have to bear in mind the policymakers are likely biased to ease policy slightly, maybe via MLF rates rather than via triple R cuts. At the same time, the currency hasn't been impacted by this at all. It's still got robust trade surplus, and we're still seeing pretty strong flows coming in, particularly to the bond market. And so we continue to see very strong performance from the currency. Equities is an interesting story, and this is one of the things that actually gives us some degree of confidence to allocate some risk, not just to China, but generally in Asia, because a lot of these headline announcements are no longer necessarily impacting all these asset classes the way they were. So we're starting to see equities sort of consolidating over the last 2 months, specifically some of those most hardest hit sectors, like obviously the technology market. So that is one source of confidence that we have. The other thing is, our positioning has also changed. So specifically with respect to FX, what we've really seen is a gradual drift stronger and stronger into long dollar trades, and really a sort of capitulation over the last month to what looks like potentially overextended positioning in long dollars. And so, we've actually been selectively adding short dollar risk to some currencies in the region already.
So interesting, and you mentioned a few words in there, such as policymakers and confidence, and so key for the market, right, to be able to try and keep a lid on unnecessary volatility, is investors having faith that policymakers have all the tools and all the data on hand to be able to make the best decisions, right? But I'm wondering, in light of the fact that clearly inflation has turned out to be not transitory, but the Fed was so insistent for so long that they thought it was transitory, is the credibility of the Fed and therefore their policy-making ability in question?
It's certainly getting challenged. I think ultimately they have given themselves enough room to respond. So if they need to speed up that timeline, they still can do so. I don't think they're necessarily running significantly behind the curve. But obviously the last few months of this year going into 2022 will be quite telling. We do expect obviously tapering to begin. And frankly, next year we believe that we're going to see the Fed beginning to normalize policy rates as well. So to some degree, the market has been ahead of that. More importantly, within Asia, we're able to find some resilience to that kind of environment. So bear in mind, since the start of the year, if you look at global bonds, the amount of negatively yielding debt has fallen by something like 35%. So that tells you there's tremendous upward pressure on the global rates markets. Whereas in Asia, where you have more of these economies and markets which have already been pricing in that risk, these markets will be able to maintain better resilience. So Korea, India, China will be able to actually find bonds that are pricing in these risks. And therefore, when you look at the relative performance versus global bonds, Asia actually has done pretty well, particularly if you've been active and had higher allocations to some of these more resilient markets.